Excellent. Thank you.
Ms. Dorsch has the facilitator script, and Ms. Dorsch, I believe we're at the part where you would ask me to take the roll call attendance.
Okay, do we need to, have you called the meeting to order?
Oh, ma'am, I'm sorry, that would be where we need to start. My apologies.
No problem. Good afternoon, everybody. I hereby call to order the January 12th meeting of the VPRA Finance Committee. And then I asked Mary Stell if you could call roll.
Ms. Dorsch,
Here.
Ms. Bulova,
Here.
Mr. Delandro, Mr. Spohr,
Here.
Mr. Watkins.
Here.
They're here and we have a quorum, Ms. Dorsch.
Very good. And I think the first thing on my list to do is ask for a motion to approve our November 30th committee meeting minutes. Do I have a motion?
So move.
Second.
And then could we have a roll call vote?
Ms. Dorsch,
Aye.
Ms. Bulova,
Aye.
Mr. Spohr,
I think I'm going to abstain. I was in Chicago.
No idea what the there.
and Mr. Watkins.
Aye.
Thank you.
Okay, and now the next order of business is a, excuse me, it's that time of year, it's time for a briefing on the budget. And I turn this over to Shannon Perry and Steve Pittard.
Thank you very much. So I'm going to take us through a couple of slides and then we'll hand it over to Shannon to go through the detail. And I'll just start out, we did change the process a little bit this year. Each year we're required to submit our capital budget to the Commonwealth Transportation Board. They provide a lot of funding to a lot of our efforts. And so it makes sense that they would have some input in our budget. So in the past, we had done our entire budget, operating and capital. And this year we decided, look, let's just focus on the capital piece because the operating side of the budget is fluid. It's got a lot of estimates. It's got a lot of information coming from outside parties that we need to get. And what we saw the first few years was between this January timeframe and we got to May and June, we were having to change that operating budget. And so to avoid that, it wasn't required for CTB. And we've got, last year we did this also. We got up there, we only focused on the capital piece and they were accepting of that. So that's a big change this year. The other item I wanted to point out that's a little bit different to the process is, we take a financial planning window as far as looking at all the sources of funding and the uses of funding. We did add one year to that this year. So because of that, we are looking at the estimated operational cost. So they must be included when we're looking at later on, we'll be looking at a working management reserve. And so you have to consider that both those sources of funds and those uses of funds are included.
So just for clarity, the previous budget in 2030, this budget ends in 2030.
Yeah, and the next slide shows it better. I got ahead of myself a little bit. So, but yeah, and what I want to say here, I think hopefully everyone leaves today feeling like it's really good news compared to last year. Last year when we presented this slide, it was not an equal sign, it was a not equal sign, and it was an unfunded $705 million, as you see in the red box there. And we appreciate y'all's faith in us. We had a lot of different options to find that funding. We felt confident we could, and we have been able to go out and, with a lot of effort from everyone in the organization, go out and get actually $829 million of funding towards that unfunded.
Real quick, if I can just add, a lot of effort from a lot of stakeholders, not just ourselves. We had great support from the CSX and BREs of the world, but also, of course, the Federal Railroad Administration, our congressional delegation. We have a great congressional delegation that really is fully supportive of everything we're trying to do. The administration, of course, I should start with them. Very supportive of what we want to do. So it's really been a total team effort. I know that it might be phrase might be used too much, but in this case, it really was a total team effort from everyone we come in contact with almost on a daily basis.
Yeah, and I will say, I kind of said it I really appreciate the faith y'all had in us. Last year was a big number and had a lot of different options, and the faith y'all showed in us to get it done. We definitely appreciate that. Adding to that, so fill that $705 million gap is obviously a big priority. And then the second thing I'll point out here is we did add that 1 year. And once again, I'm going to reiterate, it's to both the sources of funding and the uses of funding, because our operational costs, they are somewhat significant. So I don't want people to forget that we got to fund that year of 2031 uses. So with that, we are adding that year, which is, changing schedules just slightly. And I'm going to, at this point, let Mike talk a little about that. And then once he's done, then Shannon will take us through all the detail of these numbers and the movement within the budget.
Steve, can I ask a question? Adding that year, you said it was operational. So I'm assuming that after the completion of the project, we are still going to be responsible for at least a year to make sure that everything functions properly. And that's what you're budgeting for.
So we are adding the year to match to the capital projects window. So we match the operating to that window, but we have historically gone and added 5 more years just to operations. And I will say we're currently under an effort right now to refine those estimates we use. That's 10 years out. So yeah, and we're trying to, instead of up here, trying to get it here. Maybe it ain't going to be perfect. It's still estimating, but yeah, we definitely have in the plan to be able to run the trains that when we're going from 6 to 12 or 13, we want to make sure we can run that many at the end of the day. And a big part of that, honestly, I give DJ credit for this, is our cost recovery. Our cost recovery is very strong for the industry, where I think the 68% this last reporting period, and I think we'll push and trying to get to 75 or above. And so a lot of the operational costs are being paid for with the tickets.
And let me just add to that. So by operational costs, we mean the operational costs not only of paying Amtrak to run the trains, that the remaining 30 whatever percent, but also the operations and maintenance of the track that we own and of the bridges and all that maintenance that will continue to need to be done even after the road is cut. And the
GRE, they in it.
we pay the share of the VRE access fees. And that's when we add that year, all of that needs to be taken into account. And protecting Steve, it's hard enough to predict what those costs are going to be 12 months from now. 120 months from now, I could.
Yeah, it's one of those logic.
We're definitely cognizant that we want to be able to run the trains when we're done.
And that's why we're here.
So with regard to schedules, we've talked a lot in the past year about how when we get to 30% design, we have a better estimate of cost. Very similar, we have a better estimate of the scope and the schedule. So we'll be coming back to you in 11 days from now with more detail about this schedule for each project. There's always it's interesting sitting in the engineering meetings and listening to the construction staging and the meshing of projects. A lot of our projects touch each other and unified schedules, and these things do change. When you get to 30% design, you have a general idea, a much better idea than you were at 0 or 10% design of what your construction dates are. To Mr. Watkins' point, you also have dates of when you're substantially complete, and then there's still work that might go on for another year while the train might be in service over that track. You're still detransitioning from the site, making sure everything's working smoothly. So we'll be coming back to you with more information in a budget that's could be released in just a few days here. regard to the schedules.
The point is, though, is that the numbers that we're presenting today include all of that information. It's the most up-to-date information.
Yeah,
and it's exciting and I'm getting ahead of ourselves. But when we get to slide 9, where we've got that column that says, here is the status of the estimate. When we first started, they were all ones, like conceptual or barely being designed. Now they're moving forward to 30% design, 60% design. So it's getting much more exact, which is good to see.
Yeah, and the cost and schedule obviously go hand in hand. The length of the project can also determine the cost. But we do cost all of our projects out to year of expenditure. So they will reflect that.
I'll continue on. We're going to dive into the sources side here. So as Steve mentioned, and y'all are well aware, we had a really great year for the sources side. So One of the things we are shifting in the way we present this to you all and the board is that we now have the management reserve policy. So we're going to show this increase in sources going into like a working management reserve, and then we're going to have a recommendation on how that gets used. So you'll see that here as we explain what changed in the sources. So as you all recall, in Q1, we brought some changes to the management reserve. So on the left-hand side, you're going to see that $146 million that you are familiar with. But we've also gone through our financial planning exercise. So over on the right-hand side, we'll talk through some of the changes that we are showing in our financial planning window. So obviously the Fed State Partnership Grant, huge increase, $729 million coming into our plan. We also had further refinement of costs within our financial planning window. So from FY25 to FY30, changes to that base. So our operations revenues, I'm sure you all have noticed that in all of our EDRs, we consistently beat the budget on our revenue. So we've adjusted those assumptions and reflected that in our plan. So we're increasing that in our overall revenue sources from our operations, that $74 million. CRF revenues, this isn't an estimate right now. I know there's a lot going on with the General Assembly, but we are reflecting a slight uptick, but this will continue to monitor it as that goes through. So right now that is reflected in the plan. And then our investment income, there's going to be a lot more on the docket about our investments, but we are confident that the significant earnings that we've been showing are going to continue, and we're doing a lot of modeling. So this is a conservative estimate of interest and realized gains that we'll be able to bring into the plan.
Pressure to meter.
Oh, no, I know. Okay. And then as we continue to reiterate, we're adding another year of revenue to the plan. So we're adding that $335 million. What this is our operations revenue, and then another year of our CRF revenue. So that's what's coming into the plan as well. As you can see, we've got the sources kind of growing as we had from our prior plan, mirroring the last slide through the adjustment in Q1, all the way up to that $7.72 billion of sources. And then that management reserve is also growing, right? So all of these revenues are being put into the management reserve. So we kind of have that displayed a little bit differently on this slide, showing graphically how that's growing to that $1.4 billion. And then what we're going to walk you all through is the recommendation of taking $1.1 billion of this to fund certain aspects of the plan. So removing our unfunded balance, going ahead and funding those phase 2 projects, we have to add that additional year. We have some changes in cost increases, and then some new items we would like to add to the budget. So that's what we're going to dive into really next. So that's going to drop the management reserve balance to 330. We will note that is above the goal. We have some other recommendations that will likely be coming at the board, and that'll become more clear as we go through this presentation here. So any questions on sources before we flip over to the uses side of the financial planning efforts? Hearing none, I'll go ahead and proceed. In true form, there's a lot of different types of changes that come into the financial plan. We have done our best job to categorize them into like logical buckets to easily talk through. So we are going to talk through the $1.1 billion increase in uses in kind of 4 categories. So first, we are funding our unfunded position. Next, we're going to be bringing in that next year of financial planning, so FY31, into our plan to consider. We have our base budget changes, and then we have new items. This format's going to be carried over to the actual budget components on the next slides, where we'll really go into the details of what is making up these numbers. But this in total is a summary. I do want to note the last row here is operations. It's our preliminary operations adjustments. As Steve mentioned, we're not taking this to the CTB. This is just for a financial planning exercise, but we will talk through what is changing there because it does have a significant impact to the plan. Preliminary for now, though, a lot more to come when we come back to you in June on that budget component. Okay, so starting with the I-95 corridor, this is going to be our most complicated corridor, as it usually is for budget adjustments. So this format's going to continue for the next 5 slides. So as DJ mentioned, our estimate level is depicted for each of the projects. You can see that we are moving up into those high design numbers. And so that's positive news as it's informing our cost estimates and our schedules. We have our FY25 budget in comparison to what we had in our FY24 budget and the change. And we're going to walk through what's driving each of those changes here. So starting with the unfunded balance, you guys will recall the I-95 corridor had a $699 million unfunded balance. I want to pause there because we got a grant for the phase 2 projects for $729 million. And we've gotten a couple questions of like, hang on, your unfunded balance was $699. How do you get to the $729? And we're going to explain that really quick. So when we put in our application, it was for all phase 2, which includes L'Enfant, a VRE-led project. VRE had a $30 million unfunded balance in their budget, but because you need to complete all of the phase 2 for the BCA and getting that new service, We included that in our application. It was awarded. You'll see over in the new budget items, we would like to take that $30 million and give it to VRE so that they can bring that project to completion. So it's all there, ties out to the 729. It's just not explicitly clear. So we wanted to make sure we addressed it.
About a $115 million project for them. We identified the budget gap. The FRA was very clear. Does that need to be done to get the phase 2 service? It does. You need to include that. We talked to Rich Dalton and VRE. They agreed that that was their best guess estimate at the time. So there was a good news, not just for us, but for VRE and their projects as well.
And I'm just going to add quick that we're including it because that money has to flow through our financial system. If it was going directly to VRE, we wouldn't be adding to the budget.
L'Enfant is carried here as a contribution. It is an asset. At the end of it, we will own the Ford truck at L'Enfant. So that's why we continue to reflect it here, but just wanted to tie that out for everybody. So moving on to the base budget changes, you all will notice that all of these changes are really reflected for the siding. So as the sidings continue to get underway with engineering with CSX, we have a lot more information on what it's going to take to deliver those projects. So we've reflected that here. These are required projects. They do unlock service. So we are reflecting those changes and making sure that the money ends up where they need to be to get that service for VPRA and the Commonwealth of Virginia. And the last column here, the new budget item. So we already talked about L'Enfant contribution, adding that $30 million. The other project we are recommending that the VPRA board fund is the construction of King and Commonwealth. Now that that has reached final design, we have good numbers on what it's going to take to deliver that. The financial planning exercise has shown us that we are able to fund this project, and we are recommending that we put the money for that construction. As I mentioned, this is our most complicated adjustment slide. Can I answer any questions on the I-95 corridor before we move on? Very good. Hey, the categories are working. We're trying to make it logical. Okay. The Western Rail Corridor, no changes in this corridor. There is going to be a lengthy presentation brought to the full board on January 23rd. So a lot more to come on West Rail, not reflecting any changes at this time. For other capital projects, this is a simple.
Can I just
Yeah.
ask a question? Are we expecting some big surprises in the Western Rail? I am, I know.
We're expecting, we have 30% design now. We're finalizing that presentation to bring to the board in a couple of weeks. And given that we know a lot more now, we understand better the complexities of delivering that service.
So the answer is yes.
It's not as simple as we thought it was back when it was announced.
Yeah. Okay.
So what is the surprise?
I think that, well, I think the costs are going to be much, much higher than the General Assembly originally thought.
Part of the 30% design is getting options to see, different ways that we can get there. And so it's a range, or it will be. This is what we're going through now, and we're talking to the Secretary of Transportation next week to go through what the findings were. But it's going to be a range of options.
So along with the higher estimates will come a plan for how to deal with it then.
Right, we'll be making a recommendation.
It's called begging to the General Assembly.
Well, I don't know that that's true. I mean, we haven't talked to the Secretary yet, so I think we're getting ahead of ourselves. But I do know that we have been given clear guidance that we shouldn't be turning to the state for more funding. I mean, we have funding, so we'll just have to see how the next week goes and how the conversation.
DJ, we're going to do a detailed briefing at the board meeting.
Absolutely.
Before we would proceed to the capital budget at the board.
Right, absolutely. So, but we're going to brief the Secretary first.
So we'll have that discussion before we would ask for any final decision on budget.
Yeah, absolutely.
So moving on to the other capital projects, this is the last capital project section. Very simple change here. So last year we had carried a grant match for 60% design on the S line. At that time, our priorities really were pushing us towards funding the required projects. This does not get funded, and the grant actually went out without our match. So we were going to remove it from the budget, which is going to reduce that unfunded balance. We just wanted to make sure that it reconciled out, and you guys could see how that 705 was coming off. So minor changes to this category here.
So it's unfunded, the S line, how much of that is getting done?
So there is, and Mike, you want to?
So happy to talk about it. So we had just released our RFP for 30% design.
Mhm.
And I think the feedback North Carolina and others received was, let's get 30% design underway before getting to 60% design. So that application was it was in addition to the 30% design, the 60% design plan was. So we had thought about maybe helping them with a match for that. But what we're doing is we released design, 30% design for all the way from right here at Main Street, all the way down to the North Carolina border, 6 segments. We released that December 15th. So that we'll be selecting, the bids are due back in early February.
Okay.
And we'll be having a contractors, could be up to 6, it could be 2, it could be 3. They can get a mix and match of the different segments in the spring. So then we're going to move full bore with that. And I assume that we'll continue to have a conversation with North Carolina about progressing design further.
But this is very similar, and I'm glad that these two are linked. It's similar to what we just talked about with some of the other projects. At 0% design, you have no idea.
Yeah,
And so when people come to us and say, when will the S line be done and how much will it cost? We've learned our lesson and we're quick to say, we don't know.
Is it going to be broken down incrementally?
Yes, so that's where,
Because one other part of what you're anticipating as the S line is very costly. Coming across that river and weaving it into Main Street
When you're coming across Lake Gaston,
and Lake Gaston.
coming across the Appomattox.
Well, you got to do those anyway. But it becomes,
you're talking north of Petersburg.
yeah.
yeah,
Yeah, and that's why until we have 30% design, we're
Fair
not
enough.
putting numbers out, we're not putting schedules out because tools once.
North Carolina is pushing like crazy to get that S line and go right straight up to DC.
There's really about 3 segments. There's a North Carolina segment that's a current corridor.
Yeah.
A corridor that they did receive about a $1.1 billion grant to upgrade that section. The next segment is the abandoned corridor from about 9 miles in from North Carolina to the south end of Petersburg, Dinwiddie, Collier Yard area.
Before you get to the bridge.
Before you get to the bridge, correct. And then the last segment is where there's current service from where the Norfolk trains come in and
Right.
north. So there's that the kind of a South Richmond area and the Chesterfield / Petersburg area. So that's kind of 3 segments, but you really can't do much to get the S line up and running until you get to really Ettrick Station, where that connection for the Norfolk trains and all those trains
Right.
to the current service. So it will be costly. We all know our capital budget, how much it costs to build out track. So you can imagine 75 miles of abandoned track.
At least we got the right of way.
We own most of the right of way. There's some small parcels here and there, but you're right. We did receive most of the right of way. That's already in hand from CSX.
And Mike, is it true to, if I'm wrong, just jump in, to get a dedicated corridor where we can make more scheduling and more service decisions? We'd run through Richmond, across the James, downtown Richmond, instead of, I think it's the A line.
We have rights from our agreement with CSX where we purchased from DC to Petersburg actually includes the segment from Main Street along the Bellwood sub, as they call it.
Yeah.
Just if you went out the other window, you'd be able to see it down to Petersburg. And that's where we have rights. If we want rights on the pretty, what I call the Polwhite Bridge that you can see from the Polwhite Expressway, we would have to renegotiate that with CSX, but they intend for us to come up through that route to Main Street
And
Station.
we're talking really longer term,
I
but
understand. It's just an added hour.
You mean
Hour
from,
and 15 minutes, but yes, you're correct.
Okay. I don't mean to diverge.
Oh, no, it's
they're
good.
good
No,
questions.
And Mr. Watkins, we do have the $39 million in here for the 30% design that we are still, that's what we're working on.
We got to get that first.
Yeah.
We got to get the consultants
For all,
and get some estimates for some of these
Yeah.
projects we just mentioned.
Exactly.
That $39 million, we actually got a grant for that. So that's
Good.
what we have to use.
The last capital budget section is going to be our capital and operating grants. So when you look at the actual budget document in the summary, there's a lot of grants. We've tried to summarize that up just so that you guys can kind of glean the important facts here. So a lot of what we're doing is passing through grants for VRE. So there was a slight change in that $2 million. I will note that while we are increasing the uses, there's also sources. So that is a net zero impact financial plan for that first VRE pass-through grant line item there. The most significant changes that we're seeing here are the VRE track lease payments. As you all will recall, we pay 84% of VRE's track lease payments to Amtrak, Norfolk Southern, and then CSX as part of our operations costs. But they are seeing incremental costs related to just the inflation factors on their base agreements. Additionally, they are adding new service. So we are reflecting that not only to our base budget, so in our previous financial planning window, but we also are making that commitment one more year in our financial plan. So those are the main changes that we're seeing in capital and operating grants. In the last section, like we mentioned, we have the preliminary operations. We want to walk you through this just because there's some big changes here and explain what's driving that. So again, we're adding another year of our operations to our financial plan. The big changes that we're reflecting, so a big decrease in our Amtrak train operations. What's driving this is that now that we have history of starting new trains, we have a better idea of what it costs to start new trains. Our original assumptions were that it would double. We now have a lot of inputs and assumptions to add into the forecast, and we realize it doesn't actually double when you add new trains. So we were able to adjust that for the future starts for when we complete phase 1 and phase 2, and that did reduce our Amtrak operations. The other big thing that VPRA is about to undertake is implementing a cost allocation plan. What this is going to do is take the administrative costs, and it's going to put what we work on so that we have the building, our IT, and we're going to assess how much of that is really with what VPRA is doing for our capital projects, and so that we can get a real understanding of what does it take to deliver these projects. So that's what that allocation plan will do, getting the costs where they need to be. So getting a better understanding of our capital projects, but also very importantly, helping us understand what it truly takes to run our operations. Currently, this all sits in our operations budget. So now that we're making the shift, getting those costs where they should be within our actual budget, that's the reduction here. So as a result of that high level, we expect that this is going to reduce the administrative costs about $94 million. Once that gets fully implemented, we'll have a true idea of what that reduction will be.
And I was just going to say that, so that 94 million didn't go away. It had already been previously budgeted within the capital project. So maybe the net reality of it was we had maybe budgeted it twice, so to speak. Definitely believe this is the way to go to have true cost of our projects, true cost of our operations.
So I want to note, we are not asking that the Finance Committee take a formal action on the recommended budget. We do want to make sure that you are all comfortable with what we are going to be asking the board to recommend to the CTB, making sure the Finance Committee has all their questions or any comments, suggestions incorporated before we take this to the board. So I'll do just a quick summary of what we've shown you all. So obviously we've got a great year in sources. We have an increase in sources of $1.3 billion, and we're recommending that $1.1 billion get put on our program of projects. So we're going to fund our unfunded balance. We are going to have some base changes that we're going to fund. We're bringing in a couple new projects, so that additional contribution on L'Enfant and King and Commonwealth, and adding one more year to our financial plan, so funding those changes as well. So we just want to make sure any questions we can answer on the recommended FY25 capital budget.
The VRE track lease payments, have we been doing that?
Yes, ma'am. Yeah, we've been doing it. We had 1 year break, just it was something that we negotiated with them through the CR, like all of our initial agreements with the CROC and a funding strategy, but we've been paying it. I think 23 it turned back on, and we've been paying it ever since.
They had additional COVID federal credits, and they were kind of to help fund the overall plan. They agreed to give a 1 year hiatus on the 84% that we paid towards those track leases.
And so this is not a permanent thing. This is,
it's an annual, so we have an agreement that's a year, each year we sign this agreement, but historically the state has provided
done
this level of funding for those track access.
And so it shows up in our budget.
Yeah, and the 2020 session, General Assembly redid the whole transportation funding, created this authority. That was part of the agreements, I'll say, was to continue that funding, move it from DRPT to Virginia Passenger Rail.
84% of what they need to pay for Norfolk Southern, CSX, and Amtrak. And I should mention that, so we didn't double pay with CSX to maintain tracks. CSX maintains tracks that we'll own through that via repayment. Because we pay 84, that goes for maintenance and dispatching, are the two big. So we don't have to pay CSX again to maintain tracks we'll own. we were more or less pay them through the VRE access fee.
Where did that 84% come from? Is that just negotiated?
Yeah, it was, you bring it
Great
up,
question.
bring it up stars, Jim.
Yeah, it's like, oh, where's here?
Yeah. Long ago, that percentage would, some years it was over 100%, and then I don't know, we worked together and came up with 84%. It's probably been 8 or 10 years ago that the state kind of came up with that plan. So it is something that each year the board has the ability to approve. We're going to continue to recommend it because our mission is support commuter rail. So I think we all feel
Right.
should definitely do this.
And of course, VRE is contributing about $200 million to our Transform Rail Virginia capital plan as well. So there's that good relationship we have.
And I appreciate, Shannon, you closing that way. I should have opened that way with the point of today was to brief y'all, to get you comfortable with our recommendations. I don't think we're not asking for y'all to take a vote, but we wanted to get your feedback and get you this, 10 days, 11 days in advance.
So we're reviewing the budget, not approving it, giving feedback, and then it will be going to the full board
On the 23rd.
on the
Yes.
23rd.
Yes.
Okay.
Just a reminder of the process. So we'll recommend the budget on the 23rd. Hopefully you all will approve that recommendation. And then we bring it to the Commonwealth Transportation Board, the capital budget. And then we preview it in February. They hopefully take action and approve in March. And then we come back to you all in May with the same budget, whatever tweaks may happen over that time. And then you give final approval for the budget that starts on July.
Might be June.
Might be June, yeah.
I'm not sure the date of that board meeting.
Yeah, June 4th.
Early June, yeah.
It's June. So
And I guess I don't want to pressure anyone. We don't have to have your comments or feedback right today, but there is a very small window between when we have to finalize what we're going to recommend to the full board. So if you're driving home and have thoughts or questions, feel free to send them to us. But I think, is it next Wednesday or?
The 18th, I'm looking at Mary.
Yeah, because we've got to get it posted.
Is it Tuesday, the
Thursday.
20? Next, yes, Thursday, the 18th.
So by Thursday, we have to be done. So if we could get comments by Wednesday, we'll say if you have any.
I think that rounds up this presentation.
Any other questions on the budget? Madam Chair, with your approval, we'll move to investment appropriation.
Yes, welcome the opportunity to spend some time with our new investment advisors from Meter. It's all yours.
Well, thank you very much. We greatly appreciate it. I'm Eileen Stanek. I think we all met at the November Finance Committee meeting. I have with me today too Gabe Phillips. Gabe is my backup in working with the rail authorities. So it's very important that he, also hear a lot of the information that, of course, Shannon and Steve shared as it relates to the capital budget and the like, because from our standpoint, we, as we work with Steve and his team, we want to be part of that team as well. So unfortunately, Jason Headings was not able to make it today. He was out in our West Coast office and had some flight conflicts, so he's currently on a plane. But that being said, just wanting to dive into the material here because I know we have a very short window of time. What we wanted to discuss here is just give a brief update on where the state of current interest rates are today and a little bit of a historical perspective. And then talk about the expectations for where interest rates are headed. Then tie that into what would we be wanting to try to accomplish for the authority as it relates to as we construct the investment portfolio. And then lastly, how that would actually, what that would actually look like from an example standpoint, almost a recommendation standpoint, compared to where we are here today. So if we could just flip to the next page. Thank you. So this is a graph showing U.S. Treasury rates at specific points in time for specific maturities. So on the scale is, of course, showing the yield. The bottom is showing the maturities. And we start out with just kind of a quick look back at 2021, which really was just 2 years ago. That's the orange line on the bottom. Interest rates were much lower. This was prior to the Federal Reserve acknowledging that inflation was more than just transitory and that they needed to move forward with raising short-term interest rates. So throughout 2022, they did embark on raising interest rates, and that is the green line. And we can certainly see that, particularly if we are looking at, say, that 5-year mark, which from our standpoint is generally the maximum maturity that most public entities can invest out to. That 5-year rate went from a little over 1%, actually 1.26%, to the end of 2022. It landed at 4.01%. So clearly a lot of movement on longer term rates as well as short-term interest rates. And the Fed continued their path of increasing short-term interest rates through mid-2023 and had been signaling to the marketplace that additional rate hikes would occur in the second half of 2023, which contributed to interest rates reaching kind of a peak in at the end of October, such that we had the 5-year Treasury hit 5%, so moving a full 1%, and that short-term rates being anchored at that 5 to 5.25 to 5.5%. Well, market conditions, economic conditions warranted that no additional rate hikes did occur in that final quarter of 2023. And actually, the Fed pivoted at that point and started to communicate, as we'll show a little further in, that lower interest rates going forward would be warranted. And of course, the market adjusted, and we now have interest rates as exemplified by the turquoise line, showing that term interest rates were back to really where we had started out 2022. And so today, even when we look at where rates are, just to kind of put some numbers on it, the 2-year Treasury is around 4.25, 4.30, and the 5-year Treasury is slightly below 4%. So these are still very attractive levels when we put them into perspective compared to not only 2 years ago, but also in addition, looking and reflecting back on the over a decade time period that we've experienced where interest rates have been bouncing off of zero.
Hey, Eileen, before you go to the next slide, and that 5%, 5-year, 5% Treasury, what was that like? I mean, and maybe I'm wrong, but was that like a week that occurred?
Yeah, it was very brief. Yes.
Yeah, I mean,
good point.
It might have been days, literally.
Yeah, it might have been days. Yes.
Yeah. So for anybody to have predicted, let's lock in on that day, I'm sure a few lucky people did, but it would not have been easy to make that choice.
Exactly. Yes, that's a very good point, Steve. Yes, thank you. Yeah, clearly, from our standpoint, we look at taking, I would say, a longer view on the whole process. And so as we look at this, and assess what's happening in the marketplace, it's not a question of, will rates be lower? It's a question of when, and we certainly, it's fruitless to try to time it perfectly. So if we could flip to the next slide, please. So this leads into really what the market expectations are. So as we know, the Federal Reserve meets many times throughout the year, 8 times. So 4 of those times they do issue guidance to the marketplace as represented by each member of the committee. The Federal Open Market Committee issues their expectations of what they believe will be the appropriate level of that overnight rate as of the end of each year. And so when the Fed met in December, mid-December, that coincided with them issuing their most recent updated guidance. And so we have plotted that on the graph here on the turquoise line, which is showing the Fed's guidance as it relates to where that overnight rate would be appropriate. And so look, starting, of course, at our point of where we ended 2023 on an average basis of 5 3/8, the Fed's guidance is that they think it would be reasonable that they would need to lower rates by what we would consider 3 rate cuts, a totality of 0.75% during 2024, and then with an additional rate cuts in 2025, maybe upwards of 4 rate cuts. The Fed has set a long-term objective of getting the overnight rate to an appropriate level of 2.5%. And that, of course, would be contingent on the inflation levels returning to their 2% target, as well as the economic conditions being in a period where the economy is not running too hot or where we would not be in a recession. So clearly at this stage, the Fed is setting those expectations that the higher interest rates that they inflicted during 2022 and 2023 have been successful in lowering that pace of inflation. And while the economy has continued to move along in a positive direction, and so therefore the time is right in 2024 to start to lower rates. Now, the flip side of this, or I should say the other side of this, is that the Fed issues this guidance 4 times a year, making it very clear, but the market sets their own expectations and has their own opinion, and that, of course, can change each day. So kind of back to that timing issue. And the way that we can measure what the market's expectations are for the overnight rate is to look at the Fed funds futures market, which is where market participants are actually, placing money on their expectations of what should be the appropriate level of short-term interest rates. And so this is the darker blue line. And so as we can see, the market's expectations are that the Fed will need to accelerate the pace of cutting rates more than what they are communicating in their guidance. So we have an alignment with the trend of interest rates. We have a difference in the opinion of the pace of interest rates, as well as ultimately where we may land at the end of 2025. So clearly, as I said, the point is that we're at this point where, yes, the Fed is positioning to start lowering rates. So we have that to look forward to. Of course, this will all be dependent on the data, i.e. inflation and the pace of the economy. But then additionally, that will feed into the timing of when these rate cuts do start to occur. Next slide. So how do we take this information and apply it to the authorities' investments? And how do we develop, that approach as we have these conversations with Steve and team and we proceed with investing the authorities' monies? So this was a slide that was in the November Finance Committee meeting that Jason Szabo, I know, walked through. But for today, I'd just like to touch on 2 of the points that are there, which I think are really pertinent to today's environment. And the first point would be under the portfolio construction. When we look in terms of that first item, really, what are we what do we believe is a appropriate objective? And it's from our perspective, particularly in this market environment, it's creating this consistent and income that will be higher over time versus the short-term rates. Because as we see today, the expectations are that short-term interest rates will fall. So the value that can be gained by locking in those longer-term interest rates, albeit they may be lower than where the short-term rates are today, but getting those locked in today before short-term rates and longer-term rates drop any further. Because clearly from a budgeting standpoint, having some certainty to this interest income piece would be of value. The other point that I wanted to just focus on briefly is under the security selection, and that is that last paragraph, which is evaluating income and yield enhancing swaps versus active management. So we know in the past, during this past time, the authority has adhered to a hold to maturity approach as it relates to all of the investments. And one of the things that we bring to the table is being able to take a more active approach. And so what we mean by an active approach, particularly as it relates to security selection, is looking at the holdings at any given point and determining, does it make sense to sell a security prior to maturity, either capture a gain that may be unrealized within the security, or capture an unrealized a loss that may be inherent in the security, and reinvesting those funds either in a different type of asset, or reinvesting those funds in a longer dated security to, again, meet that first point, which is locking in that interest income in view of what we are seeing and expecting in the marketplace. So just wanted to bring that approach, that clarification, I guess, to how we would be looking at managing the funds as well. And then lastly, on the next slide here, this is an example of really how we would look to, we feel it would be appropriate to invest the funds, cash flow permitting. Starting out with on the table, we gathered the information from the October 31st director's report, what the allocation of funds across the different asset groupings was with the authority, and of course determine what percent was held in the LGIP extended maturity versus the securities portfolio, and then comparing that to what we would call our example, which would be if we're able to extend funds, add funds into the securities portion of the portfolio, still maintaining what may be an appropriate level of liquidity within the LGIP, so that provides the day-to-day funding that the authority needs, and and how that then would look. So in our example here, if the authority had 700, we'll say basically 700 million, even if 250 million is retained as liquid funds, that would still represent 36% of the total available funds, with 64% dedicated to the securities portion. Now, from our standpoint, and this is where we can look at the lower part of this page, the key is how would that 64% be invested? And from our perspective, we like to take a very disciplined approach. Today, we know, all of the funds are either in the LGIP or they're maturing within a year, and we would be proposing that, again, cash flow permitting, that we extend portions of those funds out almost in a strategic ladder approach beyond 1 year into that 1 to 2 year maturities, 2 to 3, 3 to 4, and 4 to 5. And so again, this would help to lock in that income for the authority over time. So really, just to summarize, as we view, where we are here today, yes, rates are headed down. Our objective is to provide that certainty of budgeted income, be able to protect the authority from what we would call reinvestment rate risk, meaning that, as rates falling, you're reinvesting at lower and lower rates. And how would we accomplish that? We accomplish that by working with the team to determine what's an appropriate level to maintain in the liquid funds, the LGIP, and then the balance being appropriated, dedicated to the securities portion, which then we would look to extend the maturities on a portion of it, all within compliance of the authority's investment policy.
So before you open the floor for questions, I just want to add two things. So we're embarking on a little different approach than we've had the past year. We mostly were in LGIP, and as Elaine just explained, short-term interest rates were actually the place to be. So we were very fortunate.
Mm-hmm.
The outlook is rates are going to go down, so we're hoping to lock those rates in. And when short-term rates go below what we've locked in, we will be gaining at that point. So a little different approach. Still, our investment policy is maintenance of the principal balance. So even though we may sell a security here or there at a slight loss, the purpose of that would be to invest it and gain more than that slight loss. Second principle is liquidity, which is, and we're going to talk a little bit about this when we get the investment policy, is we have to make sure we have the funds available to pay our bills. Then the third is the return. And all of this change, we still have those three core principles at heart. The second thing I wanted to say was, with a lot of talk about the rates here and the rates declining, and Shannon just showed you slides that had $20 million of change to management reserve for interest investment earnings. So there's that we're putting in our plan. So rates going down, we'll get less return. There'll be less earnings. Then as we spend the balance we've built up, there'll be less return. But it's a double-edged sword. As rates come down and we go to issue debt that's in our plan, we should be able to leverage more debt or certainly pay less interest. So it is these interest rates are actually a double-edged sword with respect to the EPRA. So with that, I'll open the floor for questions for the folks from Meter.
Steve, I have one. Could I start?
Yes, go right ahead.
Okay. Well, maybe it's more for you for a start. Our former investment advisors, I think they advised us on $100 million. Are we thinking that Meter would advise us on $702.3 million?
That's essentially what it is. And I think what this isn't just an example. And from working with us on cash flows of projects, so that liquidity principle, I think this example, it's not exactly what will happen. They're saying leave $250 million in that LGIP, and it's really for those short-term needs over the next year to year and a half of paying the bills of the projects that Mike's running. So yes, we're looking at it that they would manage the full 702. When I say that, what's left in LGIP is not technically under their management. Right. We would still be.
Mm-hmm. But they would advise to make the call, right? To go from $598 million to $250 million.
Yeah, and they're suggesting to us.
Mm-hmm.
The group of the three of us here working with, we're going to make those decisions of, and like I said, principal, retaining our principal, liquidity, those are always going to come first.
Mm-hmm. All right, and one more question real quick, since I'm remote, it might be easier just to get it out. When we go through the investment policy amendments, can you let us know what's recommended by Meter and why and how you came to agree to it? Some of them are easy, like the portfolio maturity, right? If interest rates are going down, maybe getting rid of that 2-year cap makes sense, but just kind of walk us through that.
Yes, we will.
Okay, thank you.
Anybody else have any questions? All right. Well, thank you all for joining us. Look forward to working.
Thank you.
Moving along, now, Patty, you heat it up that we're gonna do have some proposed, I call them minor adjustments to our investment policy that working with Meter, and then also some of it was there reading our policy and helping us clean up. Some of it's just some slight, some of it's a little bit more strategy. So with that, we're going to let Selma Nahanovich take us through those proposed amendments.
Sorry, just for clarity though, someone's going to go through them and then we're going to ask for your approval of these changes. So this will be an action item.
Yeah, your recommendation to take it to the full board, but with y'all's recommendation attached to
But
it.
this will be an official action item.
Correct.
Can I ask a question?
Sure.
So previously with our former investment folks, I don't remember doing this or approving this, an approach before. So this is,
I'm smiling because
we haven't done it.
yeah, it was a very non-active engagement, and that was one of the reasons we thought it was time to put it out. So we wanted a more engagement with us and a more active approach.
That's outstanding.
So, great. Very observant.
So who's gonna do the?
I will.
Okay.
Good afternoon. My name is Selma Nahanovich. I am the Financial Planning and Analysis Senior Manager. I'm going to walk us through our recommended investment policy changes.
And Selma, before you jump in, sorry.
That's okay.
We did print out, I believe, the current investment policy where we redlined these changes. So if you want, you can follow through that document.
Yes. So this slide is a list of topics that we're going to be discussing in more detail for the rest of this meeting. Next, please. So our first recommended change to our policy is regarding the environmental, social, and corporate governance framework, short for ESG or ESG for short. And this is on page 1 of the investment policy redline version. Our current policy requires an above average overall ESG score, and not a single investment can be below average ESG score. And this is specific to corporate notes and commercial paper. And our current ESG framework was specific to our previous investment manager. However, Meter does not have an ESG framework to apply these rating requirements. So our recommendation is to remove the ESG requirement from our policy. In addition, the ESG requirements did not have an impact in our overall investment strategy. And to date, there's been about 2 to 5% of our overall portfolio that would fall under the current ESG requirement.
Yeah. Even there, that is because that they fall in the corporate notes and commercial paper. But even then, those items, we did not. Let me put it this way. The prior investment managers, the way they actually did the scoring, it had no bearing because within those categories, almost all of, to get to AAA, you end up in the financial services industry. So to our knowledge, that scoring never had an impact.
And doing a little bit more due diligence, we did look at other agencies to figure out if they had an ESG policy in their investment policy, and we did not find any. We've looked at MWA, NBTA, Fairfax, HR Tech, Arlington Port Authority, to give some examples. Does anyone have any questions, concerns, comments?
The only comment I would make, I think it's the appropriate move to be making at this time. This and ESG and DEI are probably two of the most, I'll just call them controversial requirements that are out there right now. And I saw yesterday a member of the House of Delegates just literally undermine an agency head on ESG. And I'm not on ESG, excuse me, on DEI. And I just caution you that you're liable to run up on some of this when we start making these changes. The change is the appropriate change. All you have to do is read about the corporate entities that are coming out of and away from ESG. And it's easy to understand why we should. And the fact that you don't have many other agencies that incorporate it as well. But be alert. You're liable to hear something about it.
Yeah, I mean, I jokingly say that, most of our investments are a big chunk of U.S. government securities. And I jokingly say they score well enough.
They can't.
Well, and I'm joking, that's all I'm saying, but it has a very minimal impact is I think hopefully what y'all are taking from us is that there's such a small pool of investments that could ever get to that point. So where you might be saying, oh, we're thinking about buying a corporate note of Exxon. Is that, and Exxon actually, I think we had this debate 2 years ago. Exxon actually scored very well under the prior investment advisor scoring process. They would have scored a 4 or a 5. But then if you went over to Chevron, they were going to score like a 2 or a 1. And so, unfortunately, we never went to any of those types of investments. But it's such a small part of our portfolio, but point taken, Mr. Watkins.
Steve, apropos of my earlier question, is this a recommendation from Meter?
I think it's for us that drove this because we needed to. The policy as it was not going to work because they did not have a framework. Even if they did have a framework, the old policy was kind of based off a score from 1 to 5, and that's how you got this average. So it was going to have to change. So I think we drove this one. Patty?
Okay, thank you.
Our next item is more of a cleanup in wording under the authorized investment section for US denominated supranational agency bonds. We included Export Development Canada bonds in that language at the end of that paragraph when we shouldn't have. So that wording was overlooked in our policy. As that investment is limited to the Virginia Treasury per code. So we are just recommending striking Export Development Canada bonds from our investment policy. And just to clarify, there have been no investments in Export Development Canada bonds, so there's been no issues of non-compliance with the Investment of Public Funds Act. So this is more of a cleanup item, and you can find it on page 6.
And Meter did,
Yes.
when they reviewed our investment policy,
Meter.
they noted this for us.
If I could. So the ESG policy has been in our policy,
Yeah, it was the first revision. Yeah.
but we don't have a framework for how to apply that. Or we haven't, is that?
With Allspring, we did. So our previous investment manager, we did apply it and we reported it. They provided us kind of reports on where the limited scope of commercial paper was sitting. So we did with Allspring. So they were all highly rated when they would send us the report. So that's where it came to be, was with Allspring.
But Allspring, if y'all recall, we ended up with Allspring because when we did the procurement for our banking services, we ended up with Wells Fargo. Allspring was an offshoot of Wells Fargo. And at the last one, said, oh, we might have a lot of funds. Maybe we need to, instead of doing a whole nother procurement, we added the investment management to that RFP. And what I would say is Allspring does a lot of private wealth investing. And Meter's focus is, I'm not gonna say 100%, but it's the majority is working with government type entities. Where I think almost most governments are gonna have a very similar policy to us, where the range of investments you can get into is right off the bat. It goes from this and it's down to a small window. So yet they don't have that framework. And if they did, it would be different than what was in the policy.
I'm just trying to envision what kind of pushback we could end up having at the full board. I don't know. If Jay Fazette was still on our board.
Yes.
I don't know that we'll have any, but, I've heard not necessarily on, ESG, but that the EIPs has come up a couple
Right.
times already.
Right.
I just, it's just a cautionary thing.
When this got added, there was a lot of talk of how much does it really impact your investment portfolio? We went round and round on that, and it was hard to really measure. So at a point in time, you could go out there and see today what commercial paper would even be available, and we tried to quantify it. And it was so difficult that it was the point where it really had so little bearing, and that's why we're trying to note that and drive that home. It was in there, reactive to board members and kind of being cognizant of that. But now that we've had this shift and the fact it really had no impact, but that's the kind of the
Scope of investments that we can even consider is so narrow.
Right.
It's not a philosophical or moral question. If you were buying stocks and, all that kind of thing, I think I'm kind of where Jay would have been.
Yeah.
But it's irrelevant in this.
Well, I was just gonna add that in our discussion, we had a prep meeting with the chair, and in that discussion, part of what we were talking about was, this is not state law. This is the Ford's investment policy. And 5 years down the road, ESG, clearly, we all know it's become a lot more important in the world. And if that trend continues 5 years, 2 years, 6, whatever, down the road, the board, just like we're talking today, it can be adjusted.
We just need to make these points that would be prepared when we bring it to the board then. In other words, it doesn't make any much difference.
exactly.
See, I thought we had already flipped the page and gotten past the second.
Turn brain.
So you're just preparing me for that happening at the moment.
Did you want me to advance it? Am I on the right place?
You are, yes.
We gotta have a pool on who's gonna bring it up at the board.
So, our next recommended change came from working with Meter and reviewing our investment policy. And also, in order to increase our portfolio diversification, we are recommending to add AAA rated asset-backed securities. We are allowed to invest in asset-backed securities per the Code of Virginia. And we are recommending a 20% portfolio limit and a 5% issuer limit. And the second item on this slide is to increase the issuer limit for corporate notes from 3% to 5% in order to align with some of our other investments and some of the other agencies that we looked at as well. And I know we've all talked a lot about interest rates and maturities and in Meter's presentation. Our next recommended change is, or I guess let me back up. Our current policy around maturity says that individual investments can exceed 5 years, and our overall average portfolio should not exceed 2 years. So we are recommending to remove the 2-year requirement in order to take advantage of the market opportunities and invest in longer term securities while still keeping the 5-year limit.
While they last.
And
Yes,
this is where I was trying to tease this a little earlier, where it's our core, one of our core functions of the three of us is to ensure that liquidity. So we can pay our bills, and we're still within the 5-year window. But if it turns out that Meter's example they gave ends up with a 2.4, average maturity, and that's beneficial, we were just asking for that flexibility.
And our last recommended change is more of a clarification to clarify the requirements and responsibilities that VPRA has versus our investment manager when it comes to selecting investments and investing, buying securities. So we are recommending that VPRA is required to solicit 3 bids or offers if we were to go out ourselves in the market and try to buy securities. However, our investment manager, we're not asking them to be under the same requirements as they are already. They have to execute in our best interest. They have to follow the federal regulation. I believe it's called the best execution rule, where they are bound by federal law to act in our best interest. So we are just updating the language to distinguish between the two in this section of our investment policy.
And sometimes sometimes there's, there are a lot of governmental entities that are all trying to buy into the same securities. And sometimes there's only one person to purchase from. So you can really only get one quote. You can go to a middle person and ask them to get a quote on the same security, and they're just going to add a fee. And so it's allowing, them to function the way probably Allspring did, but not be out of compliance with our policy.
Next slide, please. So I know we talked about a lot. So just to summarize all of our recommendations to our investment policy. So we are recommending to remove the ESG requirement. We are recommending to remove the Export Development Canada bonds from the U.S. denominated supernatural agency bond section of our authorized investments. Add asset-backed securities to our portfolio. Increase the issuer limit for corporate notes from 3% to 5%. Remove the requirement for average maturity not to exceed 2 years. And update the competitive selection of investment instruments section to remove the 3 bids requirement for our investment manager.
Steve, can I ask one question about that last item? So is this an individual that VPRA is going to hire and pay according to their performance?
So we did a open procurement, and the team that just spoke to us about the interest rates and the environment, that's the firm we ended up hiring, Meter Investment. And that's when we talk about saying to them that they're going to perform under best execution for their client under those federal regulations. That's who we're talking about, is allowing them. If we do have the authority, y'all granted us the authority that we could go out and purchase these securities, we would be required to still go and get 3 different quotes.
How does this differ from what VRS does? VRS has a single manager that actually does most of the investment
within in-house.
Right.
Yeah.
And that individual is paid
probably a lot more than we're paying.
And that's why I'm asking, because of all the years I was dealing with it on finance and all that was one of the things that became a hot button every now and then. The market would, the plan would lose millions of dollars and somebody's salary went up.
Yeah. Well, and all the state employees' salaries are listed on websites.
Yeah.
you always see the VRS people, but frankly, being a state employee with my retirement, I didn't mind that they were paid very well. I want the best we could get. So
So I mean, that has to, you have to balance all of it, but so everybody doesn't get all of the portfolio of information that becomes associated with it. So you just,
what I would say I think to answer your question, Mr. Watkins, is we're very fortunate that these two ladies have gone out and collected a lot of money. So we have a very big balance today. We're not in the business to go and invest money and make returns. We just happen to be fortunate. Rates happen to take a nice turn. Long term, we're trying to build projects and run service, and
it's not quite the same as VRS.
so we laugh and we talk about, well, could we do this or could we? It's not our expertise, and and we shouldn't go hire somebody to do it, because in 3 years, 4 years, we'll have a lot smaller balance, and we won't talk so much about the return, and hopefully that answers.
I had a question on that, though. What are we paying Meter versus what is VRS paying their investment in-house person? Can we actually say what we just said here, that it's probably less?
Oh,
Yes.
well, I don't know that person exactly, but I would gamble a lot that it's less, because I know what we're going to pay me.
It's based.
You're not a gambling man.
Yeah.
What are we paying?
I haven't seen it exactly.
Mr. Cole, we can send you, it's based on the market value and basis points, so we can send you the calculation of roughly what it would be, and you'll easily be able to see
We're confident we're paying less than.
Did we use 350 million
in the example.
to get back to like 100,000?
Yeah.
And it was that is not why the selection was made, but it was the best price.
Okay.
And
The only one I had a question on that I didn't, maybe you said and I didn't pick up on it. Why are we removing the export development Canada bonds?
because I made
Virginia
because
code.
I made an error and let it slip through when we should not have had it in there to begin.
Okay.
It was only the Department of Treasury that could make that investment.
Okay.
It's not allowed for other entities.
Okay.
Luckily, we never made any of those investments, and Meter caught that and told us, and we confirmed that, yep, we had a mistake. Fixing something.
I apologize for prolonging the meeting.
Oh, no. We're here to discuss.
I guess at this time, we would like the finance committee to take action to recommend the investment policy changes as we've discussed to the full board.
And this is how I'm hoping to keep down some of the ESG discussion. It's through y'all's recommendation.
So essentially the motion,
I request a motion to approve these recommended changes to the investment policy.
did you say you would entertain?
Yes.
Okay. And happy to make that motion.
I'll second.
Still, if you could.
Call the roll.
Ms. Dorsch,
Aye.
Ms. Bulova,
Aye.
Mr. Spore,
Aye.
Mr. Watkins.
Aye.
Carries.
It's our agenda. I don't know if I have anything else for the good of the meeting.
Whoever timed this out did like an outstanding job.
Okay, no business.
Doesn't appear to be.
Okay, meeting is adjourned. Thanks for your time, everyone.
Thank y'all.
Jason, stop the stream, please.
Thank you.